Hi, Jeff. Thanks for joining me.
Hey, Steve. Thanks for having me again.
Not a problem. We are talking about the commercial industrial sector right now coming out of Q4. The headline seems to be consolidation, um, poised for maybe another wave of growth. But we've seen a need for some consolidation as a new supply nearly tripled. Um, Construction starts now are actually starting to drop, though. The balance between supply and demand is forecast to return by late 2024. This is data coming out of the fourth quarter. Vacancy did increase, but we're still at pretty acceptable levels here. The vacancy rate was pushed up to about 5.55%. That is the highest rate since the second quarter of 2016, but still only about 5.5% and well below the 15-year average of 6.4% that we've seen. And there's some signs of this consolidating. Of course, we've got some demand drivers. Manufacturing construction spending is reaching a new high. We've got reshoring the move back from China. We've got the CHIPS Act to build out semiconductor capacity in the United States. Some of your thoughts in terms of an industrial segment that seems to be consolidating some of its growth, but still looking pretty positive here.
Yeah, honestly, you kind of hit the big ones for me, which I was thinking right before you said it, is thinking about the Evergrande in China with all of those manufacturers that were their manufacturing product now become too expensive, but also don't have a local market to flood all their goods to. They're looking at the United States. And the United States is looking to you know, move back on shore. It seems like it was probably a good time for a lot of that to be built. But there's still a lot of it out there, and there's still a lot of while there may not be new, there's a lot of older stuff that's out there, and a lot of large older sites that are out there. So I think what will likely probably happen is you'll continue to see an increase in the vacancy rate. And you probably see a reduction in the price per square foot rate, side of it too.
Yeah, I think that's a good point. Is that a lot of the supply demand fundamentals look pretty solid here. But when you take a look at industrial deals, do you feel like a lot of these are maybe still a little too optimistically or too aggressively priced? Where do you think the pricing is, and do you expect we're going to see some moderation?
Well, I mean, look,
In
you're still seeing pricing that was similar to multifamily a number of years ago, where you're still seeing 4% cap rates and 5% cap rates, and those seem like viable opportunities for people because they seem stable. But I don't really know, because you could be buying at a 4 or 5%, but with the demand coming in, you could see a great reduction in your price per square foot just to keep your property occupied. So you could be looking at something you bought at a 4 or 5, it's now a 2% cap rate.
Yeah, and I think another thing, just as we look at this space, is it is a market. It's not just buy industrial and you're guaranteed to make money. We are seeing some consolidation. We are seeing some increases in vacancy in spot to spot. It really matters what you pay for a project, what project you pick. So the sector is still doing well, but that doesn't mean that there's not some projects doing better than others, and some projects that are actually kind of struggling as the market kind of adjusts to a little bit of oversupply right now.
Well, I mean, look, the majority of the stuff that's going to do well is going to be in your major transportation corridors, and probably newer stuff, even though it's a little more expensive, just because they'll have a longer runway. Ironically, one of the things that you used to see were, I don't want to say long, but longer term contracts now, because the market's been so hot for so long. A lot of these operators have been doing more residential style 1 year, 2 year leases, so that they can catch up. They can play catch up with the market instead of just giving a long term lease with a CPI increase. So it's interesting how dynamics kind of flow across the different asset classes. But in this case, I'm not, I still think it's probably a good asset class to be in. I think you can get, depending upon, like you said, where it is. Now, if you're buying an existing 400,000 or 500,000 square foot opportunity that's out in rural Georgia with no real lines and expecting to fill that up with, top tier tenants, you're probably going to struggle.
Okay. Appreciate the insights. Thanks a lot, Jeff.
Thanks.